Sandeep Dhingra, co-founder and CIO of Ashiana Capital, joins us with his thoughts on how does he see our markets behaving in light of whatever is happening to the global markets and the internals within. Sandeep, good having you. Thanks so much for joining in. The last few days have been marked by completely listless trade. I mean, save for the intraday moves, completely listless trade on the large caps or the index. But within the broader end of the spectrum, we've seen heightened activity. Do you think this could be well the norm? Because we can't justify index valuations if it moves up another 500, 600 points, the Nifty. But as long as it stays stable, the broader market momentum could well continue.
Yeah, Dheeraj, I'm not sure I could hear you too well, but from whatever I could gather, I think your question really is that the broader market is kind of looking fairly stable. Is that what you're saying?
Yes, Sandeep.
Yeah, I think I just like to point out a few things. One is clearly the I mean, if we look at the events of last week, and so it's brought one factor into mind of most investors is that probably at this level in the index and in the market, we all a lot of us, most of us believe in the India story, and the rate cycle is favorable, consumption's picking up. So all the good things apart, the risk seems to have increased a little bit more because two things. One is obviously foreign investors have significant overweight positioning in India. Plus, even if you look at the open interest levels, I mean clearly there's heavy retail long positioning. So the susceptibility to surprises or shocks is going to will increase volatility in the market. So I think that's really one thing which we should keep that in mind. And as we go forward, obviously geopolitics and that apart. I mean, I'm no expert, but let's put that aside for a moment. I think we need to see the earnings picture coming through in the next few weeks as companies begin to report, and then the market can take more comfort in the fact that look, we're playing for our economic recovery and numbers are coming through, and we can move to the next phase. My sense is we probably broadly range bound for some time, and the earnings will probably give us more direction whether to push the rally further or not. So that's just the broad view. We can get into sectors and whatever else you want.
Yeah, and earnings soon enough. Sandeep, hi, morning. 13th, we're going to see TCS come out with its numbers. What is it that you're expecting this time around from IT? Because, there is mixed opinion. While part of the market believes that the time is ripe to buy the persistence of the world and stay away from the frontline IT majors. What are you penciling in terms of a commentary from IT as a sector per se this time?
Yeah, see, when we spoke in, I think sometime in June or maybe earlier, what I had said that IT is probably a sector you want to stay away from for the next few months, and that's been the right strategy. And see, there are a number of variables on IT which are unclear, which is basically the move to the cloud and just the overall slowdown in bank IT spending plus Brexit impact. So there's a lot of different moving parts there which are harder to call. Having said that, these stocks have underperformed from where we said, I'm probably waiting to see a couple of these earnings announcements, how that impacts earnings expectation, then see if that's the time to get back into IT. But as of now, I don't think the IT sector is going to have a great quarter from whatever commentary I've gathered.
But Sandeep, just a follow up there. Even a temporarily bad business is good at a price. At what price point do you believe any of the companies that you track could become attractive? I mean, the example that I want to give is Persistent. I'm not saying it's on an uptrend, but at 600, it had dropped down to valuations which were so low compared to the growth that it will project that people saw value. There was some bit of buying that came in. Where do you think there could be value in IT? At what price points would you personally be comfortable?
See, it's a great question. I think I was looking at all the IT companies and valuations recently, and clearly a few things stand out. One is Wipro for one, looks extremely cheap. But the problem I see with Wipro is really the growth momentum is just not there. So if they show us a little bit of improvement there, that could be an interesting stock. The other one really in the larger cap is really HCL Tech. I mean, HCL has still, gone out there and said that, look, we can deliver a much better number than the others. And if if they actually go and show that, I mean, the stock is not expensive. I mean, you can have a fairly significant move in that stock. So from my perspective, those two I would be the ones which I would focus on more. I mean, TCS, TCS is still at the higher end of the valuation for the sector. So it's a little bit early for TCS, I would think. And Infosys is probably a little more interesting, but the Infosys earnings volatility is it's a little harder to stomach at this point.
Sandeep, while we are just catching our breath talking about the strength in specialty chemicals as well as tires, the one pocket which has really sprung up has been the entire OMC lot, and just the Asia's GRMs as well. They've perked up to a nice 7-month high. Are you convinced about the OMC story, or do you think this is a sector you'd continue to stay off from?
No, absolutely. We are big fans of that sector, and our preferred stock has been Indian Oil for last several months. And I think as the market realizes more and more that there's a large part of this businesses which are consumer oriented, which is the marketing side, the valuations improve. Plus, I think what has been underappreciated for several months has been that the balance sheet improvement that these companies are saying is very, very significant. I mean, IOC for one, I think their net debt levels on the balance sheet have come down significantly. They continue to come down almost on a monthly basis. So you have rapidly improving balance sheets. You have a steady state consumer business, and refining, which went through a little bit of a choppy patch, looking a little better. So I think this sector still looks very good to us.
A small trivia, I just noticed it right now. I mean, just for the benefit of a few viewers, the market cap of HPCL is 1/10 that of Indian Oil Corporation. Of course, the business is also chalk and cheese in that sense, its size and all. I'm just mentioning it's a 15,000 crore market cap company, one of the three players in the OMC space as well. Sandeep, I'm just looking at the conversation that you would have with my researcher before we came on air. And no surprise that you also believe that consumption remains that bulwark of what's happening to the bull case scenario in India. Almost everything related to consumption. You mentioned actually even the oil marketing companies having a consumption bit to it. My question to you is, there is a rally that has happened, and a significant rally that has happened in the consumption names. What from here could create significant wealth, not over the next 6 months, but over the next couple of years, 2 or 3 years? What within that basket? It's a very large basket.
I'm sorry, I can't really, catch most of what you said.
Your favorite consumption theme from here on, Sandeep?
I'm still playing with the oil marketing companies. If you ask me, given where multiples are, we're playing a little bit on the auto side, but auto's not as attractive anymore. I mean, Maruti is great company, great numbers coming through, but at some point the valuations begin to look stretched. TVS is something we've liked, but again, it's not the cheapest of stocks. But so our consumption plays is really been more through auto and the OMCs at this stage. And if you look at OMC valuations compared to these, they're still significantly cheaper.
What about NBFCs, Sandeep?
Yeah, again, great question. I think as we've spoken number of times on this forum, I mean, we've been great fans of NBFCs. We've been active in a lot of names. We've taken profits on a lot of names because they've done so well, and we've sometimes we feel foolish that we probably sold too early. But see, the macro trend seems fine, right? There's a huge market for them to gain market share. Banks are happy to lend to them because there's no real other loan growth. Rates are coming off, so everything's aligned. Valuations are, obviously we would prefer it to be more attractive, but it's a space you have to stay invested in. I think you have to keep, from our perspective, you have to keep a mix of NBFCs, and we keep moving between a few names depending on where relative valuations have moved. But it's probably the most attractive space you have to be in. But We're not the only ones saying that. Everyone's saying that. So obviously, positioning is crowded here to some extent. So, but let's watch the earnings. I think as long as they deliver the earnings, we should be fine.
Right. Sandeep, the other crowded trade seems to be tires for sure, I mean, who would have thought that MRF is going to be sitting at almost 60,000 a piece, and Apollo Tires, you pick up any stock, they're all sitting at life highs. What do you do with this sector now?
Yeah, it's look, we we was we used to be one of the very active investors in the tire sector, and unfortunately, we didn't catch this last run because we just felt that the overall tire industry macro is not looking great, but clearly it's been the wrong call. So, having said that, I really don't have a strong view on those here.
Do you believe the best is behind us? Is that why?
Uh, you know, look, the way we think of tire companies is it's still a commodity business overall, and it is still prone to massive imports from China, and it's a global industry. So typically, tire stocks don't get to be priced as consumer brands or consumer companies anywhere in the world. So so that's why it's less convincing, if you ask me. We're not sure that these kind of stocks can sustain higher multiples over the longer term.
Well, and I'm kind of uh, quite in sync with that thought as well. Sandeep, let me ask you a slightly different question. You have a fund, and therefore there will be fund compulsions as well. You at times have to book profits when you see them at times, because there are those things that you have to play with as well. Are there pockets where you would be comfortable, where you see the business continuing at a high CAGR for the next 5 years? You may book profits, sure, but you believe the business could still continue with a CAGR of 20-25% for the next 4 or 5 years?
No, absolutely. Look, see, the way one would structure a portfolio. There's a reasonable part of it where you want to be with these companies, over a longer period of time, where because you have a compounding effect that plays out. Now, sometimes it gets ahead of itself. Sometimes there's a time correction. Sometimes there's some price correction. So those things happen. But I mean, having said that, look, NBFC positions, some of the private bank positions, oil marketing company positions, some of the smaller caps that we've talked about in the past, like Adani Transmission for that matter, or Power Grid that we've spoken about. I mean, they're always there in the portfolio. I mean, the size moves around a little bit, but these are great businesses that you want to own for multiple years. So that doesn't change anything. But if a NBFC where you bought it at like Bajaj Finserv, for example, we were active buyers around 1600, 1700, 1800 levels. But once you get to 3000, there's got to be you've got to take some of that in. Whether you are a fund investor or a retail investor. I mean, such big moves in short periods of time is
True, true.
one
Okay.
needs to book some profits.
Okay. Sandeep, since you mentioned it, I don't know how much of a liberty you are at to speak about it, but since you mentioned Adani Transmission as one company, I mean, they have recently entered into that large deal with Reliance Infrastructure to buy their transmission assets as well. What's the story here, and how do you expect the business to perform over the next 3, 4, 5 years?
See, the business, it's a relatively new business. So, and see, you look at a few things in these kind of business. One is the potential multi-year growth potential for a company like this, where we see that there's given what's happening in the transmission capex, and their open bidding, there's plenty of growth that you can see for multiple years. The second thing is these companies tend to be, a decent proxy on interest rate movements as well, because 70/30 debt finance companies, typically as where you are in the rate cycle, it's a time where they would tend to benefit. Now, I don't have a very clear view on the latest acquisition. We need to do a little more work on it, but the stated objective companies had is that they would acquire assets as they build the scale for the company, and that's what they're doing. I mean, so what you're building into is a fairly large size business over the next 3, 4, 5 years. So I mean, can Adani be at 3 times its size in 5 years' time? It certainly can. So that's the top down thinking on the company. Now there will be some hiccups along the way, but broadly the opportunity set exists. The management seems very committed, and the rate cycle is in your favor. I mean, they've done a very large masala bond offering not too long back at cutting their cost of capital by a reasonable margin. So I think adding all these pieces together, it's a good long term story. And there will be setbacks, but I think over time this has the potential to become a significantly larger company.
Interesting take there. Sandeep, always great chatting with you. Thanks much for taking the time out.
Thank you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.